If you've got a 401, okay, heavily weighted toward technology stocks, and statistics show roughly 38% of American retirement accounts do, you need to pay attention to what just happened at Seagate Technology. And it's not good news. Picture this. You've been investing steadily for the past 5 years. Your tech allocation has grown nicely, maybe even outpaced the broader market. You've got positions in major semiconductor and storage companies, thinking you're riding the inevitable wave of technological advancement. Then one day, the CEO of Seagate, one of the world's largest data storage manufacturers, essentially admits that the entire industry has a serious problem. Chip making takes way too long, and it's creating a domino effect of consequences throughout the supply chain. Here's what's happening right now, and why it matters for your retirement savings. The 40% memory price increase, not a temporary blip. Let's start with the numbers. In recent quarters, memory prices, specifically NAND flash memory and DRAM, have spiked approximately 40% compared to baseline prices from just 2 years ago. Now, when most people hear about price increases, they think about temporary disruptions. Maybe a factory goes down for maintenance. Maybe there's a supply chain hiccup due to geopolitics. These things get resolved and prices normalize within months, but this situation is fundamentally different. According to industry analysis from TrendForce, a leading semiconductor market research firm, this isn't a temporary shortage. This is what economists call a structural manufacturing crisis. What that means is that the underlying capacity and infrastructure of the chip manufacturing industry simply cannot keep up with global demand at the speed required. Consider the specifics. The global semiconductor industry has been operating at near capacity levels since 2021. When COVID-19 disrupted supply chains, companies panicked and overordered chips. Then demand exploded for everything from gaming consoles to data center equipment. Now, even though some markets have cooled, the manufacturing infrastructure hasn't expanded enough to meet current demand while also clearing the backlog. Dr. Michael Dean, semiconductor analyst at Gartner, noted in a 2024 industry report. We're looking at a situation where fabs, semiconductor fabrication plants, are running at 85-90% capacity, which is unsustainably high for long-term operations. They can't run at 100% because equipment needs maintenance, yields drop, and workers need breaks. But they can't scale back either because demand is still robust. We're essentially stuck in a supply crunch that will persist through 2026 at minimum. Why Seagate's admission is a red flag. Seagate Technology is particularly important here because they're not a chip manufacturer. They're one of the largest customers of chip manufacturers. When Seagate's CEO publicly stated that chip-making timelines are problematic, it's equivalent to a major car manufacturer saying that steel production is broken. It signals that the problem isn't isolated, it's systemic. Seagate manufactures hard disk drives and solid-state drives. Both of these products rely heavily on memory chips. When memory prices spike 40%, Seagate's manufacturing costs jump dramatically. To maintain profit margins, they have to pass those costs on to customers, data centers, PC manufacturers, cloud infrastructure providers. But here's the real impact. Those companies then delay their own capital expenditure plans. A concrete example, Meta, formerly Facebook, had planned to spend approximately $37 billion on infrastructure in 2024, much of it on data storage and memory-intensive systems. However, when storage manufacturers' costs jumped due to memory price increases, Meta had to reassess. The company actually delayed several data center expansion projects and became more selective about their supplier negotiations. This kind of delay ripples through the entire tech ecosystem. The 18-month timeline. Why 2026 is critical, you might be wondering. Why specifically 18 months? Why does your $40,000 tech allocation potentially get hit right now? The answer lies in how tech companies' earnings work and when those earnings translate into stock prices. Here's the chain reaction. Month 1-3 now. Memory prices are elevated. Companies start reporting higher costs of goods sold, COGS. Profit margins compress. They announce slightly lower than expected guidance for future quarters. Month 4-9. Stock prices begin adjusting downward as investors realize this isn't temporary. Tech-heavy indices, the Nasdaq, which is approximately 45% weighted to semiconductor and tech companies, start underperforming. Month 10-18. The cumulative effect becomes clear. Multiple quarters of earnings misses, margin compression, and slowing growth lead to significant portfolio downside. This is when investors typically see 15-25% reductions in tech stock valuations from their peaks. Beyond month 18. By late 2026, manufacturing capacity finally starts catching up. New fabs come online in Taiwan, South Korea, and potentially in the US, thanks to CHIPS Act funding. Memory prices begin normalizing. The recovery phase begins. Historical precedent. The 2018-2019 memory crisis. This has happened before. In 2017-2019, memory prices spiked significantly. DRAM prices increased 47% in 2018 alone. At that time, companies holding heavy positions in semiconductor stocks saw significant losses. For example, consider an investor who held a 401k with 50% allocation to tech in early 2018. By late 2019, after the memory price crisis fully impacted earnings, that investor saw approximately 18-22% losses in their tech allocation. While the overall market recovered by 2020, the recovery was not uniform. Tech stocks took longer to rebound compared to other sectors. Willem Geertz, senior analyst at Deutsche Bank Semiconductor Research Team, noted, the 2018-2019 situation should serve as a template for what we might expect now. However, the current structural issues are more pronounced because manufacturing capacity globally hasn't expanded proportionally to demand growth. We could see longer-lasting impact. Counter-argument. Why some believe this will be brief. To be fair, not all analysts are pessimistic. Some argue that 1. Market forces will accelerate solutions. Companies have strong incentives to build new capacity. Samsung and TSMC have announced new fab construction that could come online faster than historical precedent. 2. Demand might soften. If economic growth slows, corporate spending on infrastructure might decline, reducing memory demand. 3. Alternative technologies. Some companies are exploring different architectures that require less memory bandwidth. These are legitimate points. The semiconductor industry has surprised analysts with faster than expected capacity additions before. However, most mainstream analysts believe these factors are insufficient to materially change the 2026 timeline. What this means for your 401k, specifically, let's get practical. If you have $40,000 in a tech-heavy 401k, you face several scenarios. Scenario 1, conservative case, 15% loss. Your allocation drops to $34,000 over 18 months. This assumes the crisis impacts are moderate and partially offset by other portfolio gains. Scenario 2, base case, 20-25% loss. Your allocation drops to $30,000, $32,000. This aligns with historical precedent and current analyst consensus. Scenario 3, severe case, 30% plus loss. Your allocation drops below $28,000. This assumes worse than expected earnings misses and broader market contagion. Most financial advisors currently suggest a tactical rebalancing. Reduce your tech allocation from 50% to 35-40%, taking profits from tech stocks and rotating into healthcare, utilities, and other defensive sectors that aren't as dependent on memory pricing. The structural issue. Why this matters beyond 2026. Here's what truly concerns long-term investors. Even after 2026, when new capacity comes online, the problem could resurface. Here's why. The semiconductor industry is capital intensive. Building a new fab costs $15-20 billion and takes 3-4 years. Companies make these massive bets based on demand forecasts that are often wrong. If demand is overestimated, they lose billions. If they underestimate, they face capacity constraints. The semiconductor industry has historically had about a 3-4 year boom-bust cycle. We're potentially entering a cycle that could repeat. This structural volatility suggests that tech-heavy portfolios might face more frequent disruptions than many investors realized. Action items for your portfolio. 1. Audit your 401k allocation. Determine exactly what percentage you have in tech. Most people underestimate this because tech exposure is hidden in growth or large cap funds. 2. Consider a tactical rebalancing. Move 10-15% of tech allocation to defensive sectors. This isn't market timing, it's risk management. 3. Monitor Seagate and NAND suppliers. Companies like SK Hynix, Samsung, and Micron will report earnings that signal whether memory prices are stabilizing or continuing to rise. 4. Look ahead to 2026. Mark your calendar. When new capacity comes online mid to late 2026, there will likely be a rotation opportunity back into tech. 5. Diversify your tech exposure. Instead of broad-based tech funds, consider selecting individual companies with strong cash positions and low debt. They're more likely to weather this downturn. The bottom line, Seagate CEO admission about chipmaking delays is a signal that your tech-heavy 401